The more you know, the less hard it is to stick with it. The less you know, the more you're at the mercy of just emotion. And I guess that's really the secret.
In this episode of Wisdom, Wealth, and Wellness, host Jonathan Satovsky interviews renowned investor and author Joel Greenblatt. They discuss Greenblatt's value investing strategies, the importance of patience and discipline, and the behavioral biases that challenge investors.
Welcome. This is Jonathan Satovsky. This episode of Seeking Wisdom, Wealth, and Wellness, I have a guest that has been, probably doesn't know it, but he's been a mentor to me. He's been just a wise soul, brilliant investor, just high EQ, high IQ, and just packed with just worldly wealth of wisdom, and I'm grateful to have him. Welcome, Joel Greenblatt. A little background on Joel. He started his fame, I think, investing a small sum of money, about $7 million, turning it into $1.6 billion, if I recall, in a short 10-year span, and has been a professor.
Not quite, but that sounds
Columbia
better.
University.
So, you can say that.
That's pretty good. Yeah. Columbia value investing professor, and has written many books. You Could Be a Stock Market Genius, The Little Book That Beats the Market, The Big Secret for Small Investors, Common Sense, and he's just very philanthropic, very giving with his time and his wisdom. And I'm just so excited to spend time to expand on some of the lessons that I've learned over the years. Thanks for spending a little time with me,
Sure,
Joel.
John. Good to see you.
So I'd start with, you had written this great book, How to Be a Stock Market Genius. Great title, of course. And it was a lot about idiosyncratic ideas, and really fascinating. And then you evolved to The Little Book That Beats the Market with this simple formula, buying cheap, profitable companies. So the question is, why does it work? And why don't more people do it, since it's so easy, so logical and easy?
Are you talking about the second book? Why does it work?
Yeah.
Yeah, I mean, it's a good question. I think the biggest reason is that the only way you can buy something cheap is that people don't like it, okay, for some reason.
Yeah.
And so that's hard to do. And usually there's a lot of ways to make money being a contrarian. I think the method in the little book that I sort of half jokingly called the magic formula, buy good business cheap. Really what I think people are thinking is that it's earning a lot of money now, but next year or two won't be quite as good. And that's why you're getting this bargain. And when people are trying to make money in the short term, their happy hunting ground is not companies that are not expected to do quite as well in the next year or two. And they systematically avoid those companies. But if they're still good businesses earning high returns on capital, these are usually short-term problems. And you can take advantage of those. And the important thing about that kind of investing is that it's very hard to cherry pick which companies, are not going to continue to do badly or whatever. But on average, it is a very good bet to say that on average, buying these high return on capital businesses cheap relative to their cash flows, on average works. It's like an insurance bet. You don't want to take one of them, but you pretty much know how your average is going to come out. So you want to do thousands or tens at least in the stock market, and you want to get the average is good. Cheap and good average returns are very good.
But you gave it away. It's kind of interesting because you originally gave away the formula on a website. Said, here's the formula. Go do it yourself. Go. Good luck. Have a good time. And I know myself, I started using it because I thought it was like really clever and wonderful. And then, you wrote about this, that basically people couldn't stick to it. People had a very difficult time adhering to the persistency of the process. over time? Why do you think that is? What's the human flaw?
Oh, because it's a good question, but I mean, we live day to day. We look at the paper every day, or we look at our computer screen nowadays. I'm aging myself, but and see the prices, and even in periods where the formula did incredibly well, 10-year periods where the formula did very well, there were several 3-year plus periods where it did poorly. Yet it did really well for the 10 years. And people's time horizons are, I think Jeremy Grantham put it best. It says, my very best investors, their time frame is 3.00000 years. So that's considered long-term in the stock market, but in real life, it's not at all. And sometimes it takes a lot more patience than that. And I understand that. It's much easier for individuals to withstand because they don't have clients who call up every day and say, hey, what's going on? I underperformed the market last year, or I lost money, or lost more than the market, or whatever it might be. That's very hard to do. And I totally empathize with that. It's just the way it is. But if everyone could do it, as John was suggesting, you read the book, you follow the thing, and it was easy to do, then of course it would stop working. So that's the only saving grace, that it's really hard to do. In real life, it's really hard to do. Almost no institutional managers can do it. They're I was on a lot of big pensions, and think of not pensions, endowments. Endowments are perpetuities, meaning no one's dying. It's there forever, and so they should have the longest investment time horizon of anyone, even more than a person. But there is a person who allocates to U.S. equities or bonds or private equity or whatever, and they have a benchmark, and it's seldom more than 3 years. So there's an agency problem there, and even the biggest places that should have the longest time horizon don't. And so who has the biggest advantage? Individual investors.
But as you pointed out, the individual investors, even given it, here you go, do it for free. You can't do it. So the lesson that I took away, and it's really had a profound impact on my perspective and my lessons, is trying to remind people, look, if you're not going to buy something with the Buffett-esque idea, like, ignore it for 10 years. Don't bother. Like, don't even bother getting involved, because, whether you use the formula or even using Berkshire as an example, or I think you gave the example of CGM Focus during the 2000 to 2009 period, 40% of the time it would even the best performing investments or investors are going to underperform by magnitudes of 20 to 60%. And it's not that it's not going to happen. It's you need to have that emotional fortitude to know that that's going to happen, and to be able to persevere through those periods of pain in order to, benefit by the riches over that 10-year period. And I wish I can remind people of that thought daily, every single day, because it's been tremendous.
Well, CGM example you brought up is the single best example I can think of. The market was flat for that 10-year period, but that fund was up 18% a year. But the average investor in that fund lost 11% a year on a dollar-weighted basis by moving in and out all at the wrong time. In other words, to beat the market by 18% per year, which is incredible. You have to do something different than the market. Your returns are going to zig and zag differently. And people were actually able to pile in every time it did well, they piled in their money. And every time it did poorly relative to the market, they piled out. And they managed to turn that 18% annualized gain when the market was flat to an 11% dollar-weighted loss per investor. So that is like the single best analysis. People follow returns, and they put money into funds or put money into the market after it's done well. And I'm not making fun either. It's really, really hard to do. But if you don't understand that point, that that's the way it works, you have no chance. So at least telling people that this is what's going to happen gives you a chance to do it. And you have to know yourself. And there are very few people who can withstand the pressure of way underperforming for a period of time. There just are very few. And if you think you can be one of them, you have a chance. But as you know, most people aren't going to beat the market unless, or do as well as the market, unless they understand what they're doing and they understand the perspective that they need to have to continue to invest.
So I think that's anyone that wants more details on that. The big secret for small investors is about this topic, I think, if I recall.
Well, the big secret
As you
is
said, it's still a
patience.
big.
Now you don't have to read the book.
That's all you need to know. Just patience. Just skip the reading. So, I think just piling on that, I think Vanguard shows that even people that buy the S&P 500 don't do as well as the S&P 500 because they can't even behave in that way. But anyway, so what behavioral biases do you use for yourself or family or friends or people you love? Or do you think that people are just wired with that disposition or not? Is there things that someone could do? Like strap people to posts like Ulysses? Like what do you do, or what habits have you done? Take a walk with the dog when you're frustrated, or, like what kind of things would you recommend for the people that you love to protect them from themselves?
Yeah, usually when things go bad, I hide under my desk. I would just say I'm human. And I guess what's good is if you have a plan and you know a process, and, to invest in stocks, you really have to know how to value businesses. You don't have to be right all the time, but you have to know how to value businesses, because that's what stocks are. They're ownership shares of businesses. So unless you're going to do a portfolio like, diversified portfolio, and maybe have a systematic process like I outlined, or put into an index fund or something of that nature, you have no business investing in individual stocks, because unless you know how to value businesses. So that's one of my skill sets that I learned. I went to school a long time. I studied it. I enjoy it. And I'm decent at it. I wouldn't say I'm great, but I'm decent at it, and I'm very disciplined. So, and I know I'm going to be wrong sometimes, but I leave a large margin of safety between what I think something's worth and what I pay for it. And even when I'm wrong, maybe I don't lose much, or maybe I don't lose anything. Maybe I make a little, but not as much as I hoped. And so you have all those concepts in mind when you're picking stocks. And over time, I think we're pretty good at it. And the more I know something, the less upset I get when things go against me. Because when you think about it, unless you bottom tick a stock or a fund even, or the stock market, unless you get the exact bottom, it's down after you bought it. Every time. It's almost like you never bottom tick. So every time you buy something, it's down from where you bought it. That's just the way it is. And you have to understand that. And you have to be ready for that and understand that's the way it works. And if you really like something, I mean, you learn certain things, but one of the things that I learned is, when I buy something and it goes down and I get excited because now I can buy more at a lower price, then I know I really have faith in what I'm buying, my analysis. And that's really been my best investments, when I bought it and it goes down and I'm just thrilled because now they're selling it to me at a cheaper price, and I still like it just the same. So the more you know, the less hard it is to stick with it. The less you know, the more you're at the mercy of just emotion. And I guess that's really the secret. But no one avoids the emotions of investing. It's very volatile, and it's a lot of it's uncontrollable. You can call the stock market a complex adaptive system, meaning, it eventually gets it right, but it's a really noisy ride, and you just have to be ready for that. And it's hard to do.
You had, I remember you were talking about people getting lucky, like not following a process, like it's like someone running through a dynamite factory with a lit match, I like that.
Yeah, it's like you may live, but you're still an idiot.
So it's like, oh, I'm a genius. Look, I made a lot of money in the stock market. They don't know why, So I'm curious about your process, because obviously a lot of your work is quantitative. How much do you take some qualitative? I know it's maybe not emotional, but how much qualitative or feel, to your point that you were given the example when something drops that you feel good about adding to it. It's like there is something qualitative there, because you're not, in that example, you're not purely using quantitative metrics, unemotional.
Oh no,
right? You're thinking about the business on a more
sure,
more thoughtful.
Yeah, if I'm doing concentrated investing and really picking individual stocks, then I have an opinion of where the business is going to be, and I'm not looking at what they just earned last year. I'm looking at what I think normalized earnings are a few years out. So I'm either right or wrong on that. So it's not a question. And as Buffett would say, price and value growth and value are tied at the hip, meaning part of valuation is growth, meaning how much are earnings going to grow. That factors into how you value something. So there is no growth investing. There is no value investing. There's investing. Figure out what something's worth, and what something's worth has to do with how much earnings are going to grow over time. So there's no dichotomy there. There's no reason to struggle with which way should I go, or they're the same thing. They're the same thing, and growth is part of value. I would say that very early on, thank God, I read not just Benjamin Graham, which was figure out what it's worth, pay a lot less, leave a large margin of safety, but his best student, a guy named Warren Buffett, said if I can buy good business cheap, even better. And a good business is your friend, the wind's at your back. So let's say you think something's worth $10 and you can pay $5 for it. Sounds cheap. But if the business isn't great and that $10 is at risk, maybe it goes down to 8 or 7 or whatever it might be, is that as good a margin of safety as something you think is worth $10 now and you're paying 7 for it, but you believe that $10 is going to grow over time? Which one has the larger margin of safety? I could argue the second one actually has the larger margin of safety, even though the current discount isn't quite as big. If you're in a business that reinvests its money at very good rates, or just can grow its business because it's in a great field and it doesn't need a lot of capital, it's asset light. There's a lot of scenarios in which that could work much better, and you have to know what you're looking at. And I think just knowing, as Buffett would say, your circle of competence. If you know how to do that kind of stuff, great. If you know what kind of business you can evaluate, which ones you can't, great. If you know, look, I should be an index investor because I'm very emotional and I can't one thing you get from index investing is that you don't underperform. And so it's not just losing money, right? If you're an active manager, there's 2 ways you get shaken out. You lose money because the market goes down and you went down too, or you underperform. Market went up, you went up less. With an index fund, yes, market goes up and down and you do stupid things, but you do less stupid things because you don't underperform. So you have less mistakes to make. And if you know yourself and you know that that's better for you, you don't have anyone advising you that you trust, that does good work, then, maybe that's the best for you. There's no one size fits all, and there's no one size fits the entire portfolio. There's sections of the portfolio that are good for different parts.
How has your process evolved over time? You've been at this a long time, and as you started, you were doing really cool idiosyncratic spin-offs and a lot of other things. And have things changed, sort of like how Buffett and Munger have had to change because of either time in what's happening in the world or because of the size of the money that they were stewarding? How have you had to evolve the way that you've thought about things or adapt some of your processes because of that?
Well, I taught at Columbia for 23 years, and I actually got to take one of my classes to visit with Buffett, and he handed me his fat wallet. He has a saying, a fat wallet is the enemy of high investment returns. And when Buffett first got started, he was doing special situation investing, and that was probably his highest returns of all time. And then when he had the problem of having tens of billions of dollars, very hard to invest in special situations. There's not as many, and you can't really allocate that kind of capital to that area and find little nooks and crannies that are opportunities. And the good news I told my students all these years is, well, what happens to people who are good at that? They get too much money and they have to do something else. And now it leaves a window for younger people to make their fortune that way. Fortunately or unfortunately, I never had the type of money or problems, let's call them problems, that Buffett has, of the too fat a wallet to invest in special situations. It was more that I did something for 25 years. It was very interesting. I would teach anyone to do that. I would suggest people, if they're interested in it, to do that. I think it's a great way to invest. Still is a great way to invest. Still a great way to get started. Still a great way to finish. And I could be still doing that because my wallet is not fat enough to keep me from doing that. But I like the basic principles of investing, and a way to apply those principles is in a more diversified portfolios. We do long only, we do long short, and we apply those same principles that way on a very systematic basis. And they're both full-time jobs. So the reason I switched was just because I couldn't do both. And I had already done one for a long period of time, enjoyed that, and I wanted to try something else, and enjoyed that. It took me on a little journey. Both of them did, and I still do a little bit of both, and it's kind of fun. But the diversified long short investing is really a full-time job, and so I'm doing mostly that. And some of my students or my kids that I've taught, keep my finger in the game of special situation investing, and so I enjoy that, and I enjoy just talking about it.
That's great. Do you the long short idea is actually we're I don't know when this podcast will air. We're generally delayed, but we're now in June of 2023 doing this podcast, and the philosophy of the long short strategies have been to be long, cheap, and profitable companies, and short, unprofitable companies, expensive and unprofitable companies, which is beyond logical and reasonable. And particularly, I don't know if there's periods of time where that they're more extreme stretches of those situations, but it seems like the last couple of years, should be setting up really nicely for that ideology. Do you feel like it's more pronounced at this moment in time than it's been in a while, where that you get more excited? Wow, the extremes are stretching,
Sure.
Better for me.
Sure. Well, in the little book that you mentioned earlier, and we still have 30-year study, updated till today, where it shows that if you just buy good and cheap, and you divide into deciles over a 30-year period, decile 1, the best combination of good and cheap, beats 2, beats 3, beats 4, and the 10th, meaning expensive or losing money and not good, not earning money, is the worst. However, if you literally put $1 into the top decile and shorted the bottom decile during those 30 years, and you just did $1 for $1, you would have gone broke 2 or 3 times, because over time, it's true, it works. But in the short term, if you went $1 long and $1 short, your longs may be, let's say, a 0.5 beta, your shorts may be a 5 beta, and you're really 10 to 1 short. And so there's 30 things you really have to balance, and you might be totally skewed into different industry groups. There's a whole bunch of reasons why there's a real art to balancing those portfolios, and you cannot go long short and and short the extremes. You would never do that, or you wouldn't do it for long, because zero doesn't compound after, right? If you lose all your money, you can't, compound off that. So you would never do that.
Yeah.
It's a great example to show that if you're very patient on both sides, or one's a bad strategy long term and one's a good strategy, but as a long short strategy, it's totally different. You have to balance them along the way, or you'll never make it through. So it's great as an illustration, not great as a strategy. And the long short strategy, I would put in the category of do not try this at home. Just as you have to live through good and bad periods, just being long only, in long short world, it's the same. And in answer to your question, yeah, it's a great time. The opportunity set is really great for long short investing the way that we do it, because the valuations are very skewed right now. Doesn't mean it'll happen in the next 6 months, but over the next 2-3 years, it's almost a certainty that this will correct. Once again, don't try long short investing doing it, but I would just say it informs the way, where the opportunity sets are, at least on the long side, and also should set your expectations for each group at this point. One is very, very expensive. One is very, very cheap. And I'm most excited about the long only version of the very cheapest are really skewed. I'll give you one small example. We ran outside money from 1985 to the end of 94, 10 years, and returned all the outside money after that, continued to run our own portfolio. And in 98, so it's 13 years after we started, we had our first loss year. Just running a concentrated portfolio at that time, but the market was up 28% in 1998, or 27, I don't remember. We were down 5. I remember that. And
it's very tough year for value investors.
Yeah, very hard to do that. And then in 99, market was up another 21%. We were down 5 again. In 2000, the market finally fell. It was down about 10%. We were up 115%. It wasn't because we were idiots in 1998 and 99 and all of a sudden geniuses in 2000. It's just that we followed a process and we finally got paid. But that's an ugly journey and very hard to do. And, but a great example, just thinking about those numbers, how skewed the market can get. And, if you really do your homework and at least stick to what you know and have a process, I don't think we're anywhere skewed like that now, by the way. That's not going to happen. That is hopefully a once in a lifetime skew. But, things rhyme. And right now we're not nearly as extreme, but we are towards the ends. And so I agree with you. I think that should be a very good opportunity.
It's kind of funny because I remember that period vividly. And I remember John Marie Avillard saying that he would come home every day and his wife would say, he would feel like an idiot, in the late 90s. But he was. I
do that every day, but that's okay.
Yeah, interesting. So, question around the idiosyncratic stuff that you've been involved in. When you wrote that original book, I know I vaguely recall you telling me that at one point in time, like one of your best investments that you ever made was investing in backing one of your friends that got into the investment business, Rich Pazina and Pazina Investment Management. That might have been one of your best investments. How did that come about? And, what compelled you to make a decision to invest in another asset manager? It's kind of interesting, maybe an interesting story for some.
I don't know, interesting, but I went to school with Rich at Wharton, and we actually did a research project together, testing, and it ended up getting written up in the Journal of Portfolio Management, but it was testing Ben Graham's stock picking formula. And back then, computers took up, football field, and databases consisted of us taking a pencil and Standard & Poor's stock guides and writing down the information that we wanted to put into the computer. And so this was a big, long project, and turned out, what Ben Graham had done 40 years earlier still worked, and it worked incredibly well. And we worked on that together, and I knew Rich from school. He's the smartest guy I knew at school. And so kept up with him. He was running Sanford Bernstein's U.S. equities, and he said to me one day, gee, I'd like to at some point go out on my own. And I said, well, if you ever do, I'd love to back you. I mean, it was one of the easiest decisions I ever made. And he's really one of the highest quality, smartest, nicest people I know. So, I mean, it really was just kind of easy. You don't get that opportunity too much in life. Just that was like an easy one. They don't throw you pitches like that ever. And,
That's awesome.
It's been fun ride. And, I love Rich to death.
That's a good win-win. That's a good win-win story. So, couple like last closing questions. You've published many books. I believe you're a pretty avid reader. Are there any books that you've read recently, or that you're reading, or you would suggest to someone at different stages of their career or their life that they should pick up and read, whether it's about investing or life or psychology or behavior or Kabbalah? Like what do you found most striking to you these days?
That's a good question. I mean, besides the usual investment books, I am, of course, you're asking me the question, I'm blanking on some of the names. There was one of the funniest books I remember reading, I was just thinking about it the other day, was a book written about, let's see. I think it was called The Only Rule Is It Has to Work. And it was about these guys. It was like a Moneyball type book that was really kind of funny because these guys had no money. And they took over a minor league team that was like 9 levels below MLB. And they tried to, coax people who had been good in high school to go play on their team, things like that, using all the analytics that you usually would. And it actually was really more of a discussion of how people aren't statistics. And, it's sort of the collision of human beings and analytics messing up, the best laid plans. And it was a little bit hilarious about how it all went or how it all went. I don't want to ruin the book, but I don't think anyone else read it. So I thought that was a really fun book. I'm trying to think of what else let's see what I could recommend to people. I would say any biography of Benjamin Franklin. I've probably read at least 3 or 4, and I think the most motivating, interesting, and just seeing how interesting one lifetime could be, but also just the way he thought. And I think any good rated biography of Ben Franklin would be probably almost my number one recommendation.
Oh, I love that.
I love that. So,
I love that.
I like reading usually nonfiction, and there's always something out that I'm enjoying.
Well, I'm super, super grateful that you spent the time with me today. How would people find you if they want to read about you, learn? Go to gothamfunds.com. What's the best best place to get information?
I really learned not from business school because they taught me don't go into the professional money management business. Pretty much, markets were efficient. But I learned from reading. And so I wrote books. And so go to Amazon, and, I'm proud of almost everything I wrote. You decide what I should be proud of if you read some of them. But I had fun writing them, and it was my way of having fun and giving back. And so that's really the best way to learn about the evolution of how I've thought about investing for good or bad. And I'm proud of most of them. And, I think you can learn something from each thing that I wrote. So, and it was my attempt to give back something.
Well, you've done a great job. I know I've benefited immensely, and I know that anyone that is lucky enough to pick up any of your books is gonna glean something that will contribute to their wealth, their wisdom, wealth, and wellness over time. I'll leave you with one last thing: is if you had an alter ego career path, a road unsurprising, something untaken, what would you be doing aside from investing?
Oh, I probably would have tried. I don't know if I could have been successful as a research scientist. Stock market's more in the social realm, and you're not always, it's not linear, and you don't necessarily get paid off what you deserve. But the natural world kind of has like great secrets that if you uncover them, those are truths. And I think it's also a way to give back and do something fascinating. And, I've met enough research scientists that I respect that it's very hard to do that, but also that's what I would have done. I would have pursued.
Hey, Grandma Moses started painting at 80. You never know. You still got a long journey ahead.
Well, good luck with that. Maybe I'll paint. Okay.
Well, thank you again, Joel. I appreciate the time, and look forward to seeing you down the road. Thank you.
Satovsky Asset Management, hyper-personalized wealth management that has created joy and abundance since 2007.